Welcome to another episode of Good Value by Antipodes.
Welcome to another episode of Antipodes Magnified, our deep dive into markets and the Antipodes global portfolios. Joining me today is Portfolio Manager Vihari Ross. Welcome, Vihari.
Thanks, Alison. Nice to be back.
Another strong quarter for global equities, up around 6% in Aussie dollar terms. Asia really led the outperformance, with China, really driving that part of the market. Chinese equities were up around 20% for the quarter. And another strong performance from US equities. Let's start with China. What really drove the performance of that market?
Yeah, look, so China has been a really strong market, as you've said. It's sort of the return of animal spirits to Chinese equities. But I think what we've seen is really different in China this time around, in that historically it's been driven by government stimulus, and encouragement. This time we are getting government bond issuance, government, encouragement, of local lending and of bank lending. But really, it's coming from the household rather than by government spending this time around. And, in fact, there's sort of an interesting stat where in the upper demographics, the Chinese consumer hasn't gone backwards in terms of their balance sheet because the rally in equities has made up for the decline in property. So what you're seeing is a real shift here in what households are doing, in investing in their own market, as much as we've seen in places like the US. And Chinese equities are still cheap in the scheme of things. We're looking at a 15 times multiple versus 24 times for the US. And there's really still a lot of opportunity sitting in Chinese equities because it's driven by more grassroots desire to buy their own shares. So we're finding, structural growth, we're finding quality and defensive assets, at compelling valuations. In China, it's about 10% of our portfolio at the moment, and we've got those structural growers like the Tencents, like Key Holdings, which is the realestate.com of China, that sort of round out sort of a broad number of securities in our Chinese part of our portfolio.
And I think also we're seeing the return of foreigners as well, so foreign investors as well as domestic investors. And there was that sort of quite famous, it was in Bloomberg, and you would have seen it, Cathy Wood returning to China after all these years. So I think it's that combination as well of foreigners and locals.
Absolutely. I think it's that, as the market has started to rally, people have maybe some of that fear, that equity risk premium has maybe come out of Chinese equities, and you can see the impact that they can have very quickly on valuations, particularly when they're depressed and compelling.
Okay, so we've had a liquidity-driven rally while the domestic recovery in China still very much looks like a work in progress. So what do the fundamentals look like? And is this rally in China sustainable?
Yeah, look, I think you're right to point out there's actually a few things going on here. If we think about what's driven the rally in Chinese equities, it actually has been quite narrow in the scheme of things. It's been driven around the technology sector. The AI DeepSeek moment has sort of continued on, as those Chinese companies have come out with, their new innovations and their new developments in their own development of AI chips and the like. Meanwhile, real estate, consumer discretionary, that part of the market has lagged behind and hasn't really participated in that concentrated rally. I think what you've seen on the technology side, though, is real. You've got, Chinese imperative to get to 70% self-sufficiency in AI chips by 2027. It's actually pretty soon in the scheme of things. And the scale of investment required to achieve that is going to be very material, very substantial, the likes of which we've only really seen in the US to date. So that's something that's quite meaningful. We think it's going to continue to drive, those equities in China. The other part of the equation, of course, is what's going on at the household balance sheet level. We talked a bit about, the improvement in household balance sheets through equities, but the reality is that the property sector still matters a great deal. That's where that wealth effect has impacted, Chinese consumers to a very significant extent. And we know that they've sort of essentially hoarded those excess savings. There's $6.5 trillion of excess savings sitting on Chinese balance sheets. That's a third of GDP sitting there. And, we really see that as a bit of a coiled spring, because once that property market starts to bottom out, we are seeing those green shoots in, the secondary market sales, people selling to one another as opposed to from property developers. And as that recovery starts to take place, you can see that opportunity for consumer confidence to revert upwards. And of course, those excess savings to be deployed. And at that point, I think there could be a real broadening out of of performance in Chinese equities into those other sectors that have lagged behind so far.
Okay, so in the US, markets pushed higher driven by AI enthusiasm. We also had the Fed cut rates, along with an expectation of further easing to come. Now, we're going to unpack our views on the US economy in greater detail in our podcast episode. But what are your big picture views?
Look, I think what we've seen in the US is clearly that rate cut cycle has begun. There's an expectation of more rate cuts. And overarchingly, the market's interpretation of that was very much, soft landing style rate cuts. And we're going to continue to have this, Goldilocks scenario where, the Fed expertly sort of navigates, a slowing economy, continued inflation and the like. And I think what you're seeing, though, under the hood there is an easing of those labour market conditions.
Yes.
Wage growth slowing from, high to mid-single digits to sort of low single digits. You're seeing the number of more job seekers than job openings.
Yes.
And all of that is sort of a cooling and certainly could be a soft landing, but not if that continues. If it continues, labour market continues to weaken, then you could end up in a scenario where actually that mismatch falls into the camp of a more dramatic slowing. And the reason that matters is because US equities are priced at 24 times earnings, which is certainly a significant premium to its own history. And essentially that means priced for the environment to stay benign, when in fact under the hood there is these sort of percolating risks that, that we can start to identify and the Fed has started to identify, which is why they've started easing.
The rally in US equities really feels like an AI story. Demand for chips and data centers and power isn't easing. And we're even starting to see examples of vendor financing, where I lend you money to buy my goods. How are you thinking about the sustainability of this AI rally and the sustainability of the AI investment cycle?
Yeah, look, I think that's exactly right. You've had this, significant exuberance around AI investment in the US. It's not to say that the value chain of AI is US only, but certainly the big headline stocks, the NVIDIAs of the world, is very much a US story. It's driven a US rally, US exuberance. I think where this is going to go, I certainly don't deny that there's a long investment cycle in the infrastructure build of AI yet to play out, and that's going to continue, be that through frontier model development, be that through the DeepSeek type, cheaper versions of model development. But really where this is going and where AI is probably most mispriced is in the adoption of AI, using this new technology to make your existing business more efficient or better or get better, advertising revenues, whatever that may be. And the adopters of AI are truly global.
Yes.
And that is, every company, every small business through to the largest companies in the world. And I think that's where we see a lot of opportunity when it comes to investing in AI.
Okay, so that first phase of AI, really US-centric or US-driven, but as you're saying, where to from here is going to be a much more global opportunity. And you spoke about companies that, beneficiaries can be much more widespread. What are some examples of adopters that you're thinking about?
Yeah, so I think if you think sort of more broadly, the first thing is that companies need to get their data organised onto the cloud. So you are seeing certainly the cloud revenue growth still growing rapidly as those data sets just get moved over and organised on the cloud format. But then you've got companies that are already digitally native that can benefit. Companies like financials, have a lot of opportunity for the most part to make that shift to the cloud and then start using AI. But also companies that we own, like Capital One, that already have their data on the cloud, they can start deploying it and making their businesses more efficient. The amount of work that, humans currently do in underwriting and paperwork and approving loans in underwriting, that's a good opportunity. And in healthcare, that's another place where there's a lot of data being amalgamated and assessed, and certainly there's an opportunity for the returns on that big, investment that takes place in finding new drug discoveries, to be uncovered by AI as well. They're probably two good examples.
Yeah. Now, we've also seen a significant surge in retail participation in global equities. What does this mean for market sentiment and positioning?
Yeah, look, that has been a big shift in markets. The amount of retail participation in certain stocks in particular can, on some days can be, more than half the value traded, where you've seen, that big swing of momentum back into equities, since that 2022 drawdown. And it's really, I would say, increased the sort of the volatility and momentum in the market. It has led to some big swings in stocks at points in time. A lot of it's around the mega tech complex,
Yes.
AI value chain complex, but also more recently, commodities like gold and silver and uranium have been popular as well. And the other thing I should also mention in the context of that is ETFs. It's sort of probably led more weight into that passive sort of investment that takes place in the market. For us, that often reveals opportunities because it has created, mispricing in certain stocks, both long and short. But what it does create is that momentum, goes one way, and as always, momentum works until it doesn't. And the risk there at the index level in particular is when the momentum starts moving in a different direction. And that's something we do actually track very closely in managing our net in our long-short portfolio.
And it's interesting because, as you say, retail has sort of been quite a consistent buyer. So they've really supported the market. And then if we do get a drawdown in those, in the places that they favoured or the parts of the market that they faded, as that starts to unwind, that can, I imagine, have quite meaningful implications for index returns.
Yeah, absolutely.
As it has on the way up,
yeah,
and then do
and
on
that's exactly what we did see.
Yeah.
In that 2021, 2022, you actually saw a big reversal in retail flows. And to some extent, there's a structural element here. People are, in fact, interestingly, even in lower demographics, you're seeing more investment in equities than ever before. But partially that's because you can't invest in housing really easily, and the cost of getting a loan is higher than it's been in a long time.
Rates
in
have
the US.
been very high.
So exactly. So then there is a little bit of maybe a cyclical element to that flow into equities as well. And so it's one of those things of, this is driven markets, but it may not be a persistent supporter of markets, I would say, going forward. It certainly has been to date, though.
Yes. Turning to the Antipodes global portfolios, the Global Value Fund, which is our long-only strategy, delivered 7.9% for the quarter, which is around 1.5% alpha versus the MSCI ACWI. This takes performance for this calendar year to 20%, with alpha just shy of 10%. And this is despite not owning some of the mega cap tech names, which have really driven the index. The key performance drivers for our portfolio were our Chinese holdings, particularly Tencent and EV battery maker CATL, as well as our exposure to gold equities. Bahari, let's start with Tencent. Now, this is a key holding in our global portfolios. What's driving performance there, and how are you thinking about the outlook for this particular company?
Yeah, look, Tencent, we talked a little bit about the rally in Chinese equities around that tech complex. Tencent is clearly one of those names being a dominant player across not just, tech in the sense of its WeChat platform, but also it has a cloud business, its advertising business, its gaming business as well. So this is one of these, quality growth companies actually where you can still find value outside of the US. So you've got, we talked about the opportunity to deploy AI to make your own business better or get better returns. Tencent is a great example of that. We saw what Meta has done
Exactly.
In monetizing all those eyeballs in the developed world. Tencent has 1.4 billion monthly active users on WeChat, and they're still at the nascence of really deploying that technology to target advertising better across those eyeballs, and that's going to generate 15 to 20% growth in their online advertising business. It's very high incremental margin, so it's driving, profit growth 1.5 times that of their revenue growth in that business. They're continuing to get cloud growth as well as that migration of information to the cloud takes place. And you've also got opportunities to deploy AI in their gaming business as well. So this is a business that's really compellingly valued, double-digit growth, 20 times multiple, a big discount certainly to Meta, the equivalent business in the US as well. So we still like that name.
And what about CATL? This is a more recent addition to the portfolio. What's the investment thesis there?
Yeah, so CATL is a leader in EV technology and batteries. They actually have significant technological leadership here on a global basis. So you've got growth in this business coming from clearly the usual EV, auto vehicles, but also commercial use cases as well. They've actually got 40% of their sales now, of their gross profits rather, coming globally, not just within China. And you're getting very high returns on incremental capital here. And they are a market share gainer because of that technology leadership position they have. This is a stock trading at 15 times for a growth profile of 20% per annum. So that's been a really exciting new addition to the portfolio this quarter.
Gold's been on an absolute tear this year, with the gold price up around 50%, and around half that gain's actually come this quarter. Barrick and Eldorado have been key contributors to our portfolio performance. Barrick in particular, which has had an incredibly strong quarter with that stock price up 60%. How well underwritten is the gold price, or how well supported is the gold price? And how are you thinking about our key holdings?
Yeah, look, I think gold, as you said, it's been the talk of the town in recent times. But I think what you're seeing is really interesting. Certainly there's, potentially a speculative element to some of that, very short-term rally. But more broadly, what you're seeing is that government deficits are widening. And, it's almost, back to that sort of gold as a store of value type concept. And you've got, net saving countries like China, like the Middle East, that are looking for, alternatives to the US dollar, and, a preservation of value here. And that's sort of where gold has come to the fore as the obvious alternative. And in that sense, it does have, more structural support as opposed to that more exuberance that is being attached to it in this short period of time. When it comes to something like Barrick, that's a stock that we, bought for idiosyncratic reasons. And obviously the gold price has really made that stock run really hard fast. But what you've got there is a business that had a lot of, self-help attached to it. There's an opportunity to improve their sort of operating profitability, close down some plants that were, where there was a lot of unionised workers and they were sort of losing a bit of money there. And, that improvement was going to drive that business forward. In addition, they've made a discovery in Nevada with their 4 Mile gold mine there, and the quality of the ore coming out of that is among the best in the world. And as that sort of comes into development, that's a significant positive coming into the investment case for Barrick as well. And this is a stock trading at 0.5, 0.6 times NAV. Still, we're looking at a double-digit free cash flow yield, even with the a 30% reduction in the gold price where it is today. So you really still have a very compelling underlying stock-specific investment case coming through in Barrick. Eldorado's similar in the sense that it's also trading at a discount to NAV, but a high quality expression of gold mining exposure than Barrick. But both positions are still in the portfolio.
To round out performance, the Antipodes Global Fund, which is the long-short strategy, returned 4.4% for the quarter versus the index at 6.4%. And the shorts were the main drag there. Vihari, can you give us a bit of colour on the short book?
Yeah, so I think with the shorts, we do have our single stock shorting, our basket, our centric shorting, as well as our tail risk hedging component of shorting. I think in this very strong, sharp market rally, that's where that tail risk hedging and, index shorts, are not likely to work, but the purpose of them is to provide hedging and tail risk management. So we wouldn't expect them to work in that context either. What I would say also is that the cost of insurance, index level volatility has been so low. It's in fact at 5-year lows. And as a result, tail risk hedging is actually quite cheap insurance in the context of exuberant markets. And so they have dragged in the quarter, but are in place for a reason.
It's also worth highlighting that the returns of the global long-short strategy this calendar year remain very strong, with performance around 22%, outperforming the index by over 11%. That's all for this quarter's performance update. Vihari, thank you very much for your time and your insights. And make sure you tune into the next episode of the Antipodes Good Value podcast, where Vihari and I look under the hood of the US economy, as well as delve further into our broader portfolio positioning.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.